What is up guys, Taiki here, and in this video I want to go over some various stablecoin farms and the risks associated with them and my general thoughts on stablecoin farms right now. And also I'll be asking an open question on why do we hold stablecoins in the first place? What is the utility of stablecoins? And that might sound like a dumb question, but if we can, get to the fundamental reason for why we hold stablecoins, I think with the powers of DeFi, it'll open up some new DeFi strategies that I think will be more interesting than just holding cash and entering various stablecoin farms. So that being said, let's get right into it. None of this financial advice. If you like the content, please like and subscribe. Leave a comment in the comment section below. I am a DeFi guy in this environment, so I need any dopamine that I can get. Okay, so the question is, why do we hold stablecoins in the first place, right? This might sound like a dumb question, but for me, I'm speaking for myself. We buy stablecoins because when we sell something for dollars, we're buying stablecoins, right? And also, if we're holding stablecoins, then we're making a conscious decision that we don't want to buy a risk asset like internet coins, right? Internet money. But we hold stablecoins because we decided that we want to go risk off somewhat and create optionality, right? If you have cash, you can buy things whenever the hell you want, right? It also helps reduce volatility in the portfolio and protect downside. I think this is the reason people hold cash. But if this is the reason people hold cash, then you can do other things with your stablecoins. Like, you don't just have to hold cash. You can buy things, and then you can hedge that by shorting another coin, and maybe you can earn more yield doing that than just holding cash in a bank account in a centralized exchange, or just some stablecoin farm with asymmetric risks associated with them. So here's an example. I'll be giving various examples, and it might not make sense at first, but near the end, I think it'll click. So what's the difference between someone holding 100% cash and then person B holding $80 in cash, $20 in Bitcoin, and then shorting $20 worth of Bitcoin using some other instrument, right? Of course, there are funding rates. You're also going to be earning yield on your Bitcoin. So it kind of depends what tool you're using. But both people are essentially delta neutral, right? They're essentially 100% in cash. Maybe person B is 99.5% cash, but essentially the same thing. Second example, what's the difference between someone 100% cash and someone else having $80 in cash, $20 in Bitcoin, but then using that as collateral to borrow $40 in Bitcoin and entering a BTC USDC farm, right? And staking those LP tokens and earning liquidity mining rewards. Because if you borrow $40 of Bitcoin and then you're entering this farm, you have to sell half your Bitcoin, right, into USDC. So technically, you're almost the person B is almost delta neutral, not perfectly, right? Because there's impermanent loss, there's borrow rates and whatnot. But you kind of get the point. Second example, or third example. How about someone borrows $30 worth of Bitcoin and enters Try Crypto, right? Or GLP. Or you have $80 in cash and you long $20 of this volatile altcoin, right? Whatever it may be, and you hedge that by borrowing $40 in AVAX and then buying GLP with it. Okay? So all these examples, they're not the same, right? Holding 100% cash is 100% cash, and then with every example, I kind of became more dangerous, I guess, right? I added more volatility the more further down I went. But the point is, you can still buy things and still mute volatility in your portfolio by using money markets and using DeFi, okay? Because you can use stablecoins as collateral, borrow a volatile asset, and use that to hedge, whether you just sell that volatile coin or you enter something like Try Crypto or GLP, and that position is earning you yield. Of course, it's not 100% delta neutral, but it's close. It opens up interesting strategies, and you can use stablecoins as a tool to initiate pair trades. That's the point I'm trying to get at, where because if you think about the market, there's a lot of opportunities out there. I think there's a bunch of bargains. Of course, macro kind of sucks, so you might be in this position where things are cheap, but I want to hold cash, right? And what I'm saying is that you can still technically hold cash, mute volatility in your portfolio, and still buy things by shorting things that might be less attractive, in the short, medium, and longer term. And you might be asking, why add so much complexity, right? Why not just stablecoin farm on various applications? And sure, you can definitely do that. But that's not really a fun video, right? It's put your money in this stablecoin farm earning 4% APY. It's so good, right? It's not a fun video, and you don't have to listen to me, right? Of course, I'm just gonna share different things you can do, and maybe it'll, I don't know, like give you a light bulb moment or something. Because there are interesting stablecoin farms right now if you care to do research or you look under the hood. I was in this farm for a couple of months, and it was paying me really handsomely. Right, this is a USN USDT farm. USN is 1-to-1 backed by Tether, so you're essentially staking Tether and earning 12% APR. However, I'll talk about the risks later. There's also this farm on Algorand, Volksfinance. You can stake Tether, earn 10%, or stake USDC, earn 7%. ALGO Fi, another Algorand application, and you can earn like close to 7% staking these individual stablecoin assets. All these farms, I'm farming on Algorand right now, right? And I left the USN farm for various reasons, which I'll get into. But these are pretty good farms, right? With USN USDT, you're earning more dollars, right? You're earning more Tether, and with AlgoFi and Volksfinance, you're earning both USDC and also more Algorand, which might be interesting for certain types of people with different types of market views. However, these stablecoin farms, it's cool, right? But they're not without risk. I talked about this over a month ago on August 3rd about the risks of bridges and Alt L1s right now, and why I think it makes more sense to deploy more capital into safer applications or native assets on ETH or L2s. L2s still have risks, which I'll go over. For example, the Arbitrum bridge, there was an exploit. Fortunately, a white hat hacker found it, and they received a 400 Ether bounty. And also the Rainbow Bridge on Near and Aurora, there's been several vulnerabilities, right? And fortunately, all these vulnerabilities were found by a white hat hacker. So these white hat hackers received a bunch of money and they patched it themselves, or the bridge was able to patch itself. But with these bridge assets, most of these bridges they use this mint and burn mechanic where if you bridge, let's say USDC into Near, the USDC that you hold on Near isn't like real USDC, right? It's a bridged asset, where if the assets underlying the bridge gets exploited or it gets compromised, then these bridge assets won't be backed by anything, therefore making these assets worth less than $1. We saw this with the Harmony bridge hack where there was a couple $100 million in the Harmony bridge. It got exploited, and then everything on the Harmony blockchain was worth 20% of what it was actually worth. So with these bridges, there are risks, and that's why I expected more TVL to migrate onto mainnet ETH, because mainnet ETH is the safest place to farm and whatnot. Of course, USDT and USDC and these other Alt L1s, they're trying to mitigate these risks by issuing native Tether and native USDC. For example, Algorand has both native Tether and native USDC. So if USDC, right, if Circle is issuing USDC on the Algorand blockchain itself, then it's not opening themselves up to bridge risks. And yesterday it was announced that USDC is going to be natively issued on Near, Cosmos, Arbitrum, Optimism, etc. So over time, right, these bridge risks are becoming less and less so. But right now, in the short term, those risks do exist. And I don't necessarily think that these bridges are that risky, right? If they haven't been exploited now, then chances are it's not going to be exploited in the future. However, I don't really know the probabilities of these exploits happening. So it's just good to know that these risks exist, and you should allocate accordingly. And even Algorand, right? Both Tether and USDC is native. So if you go to KuCoin and you bridge into Algorand, right? Opening yourself up to bridge risks. But Algorand uses this new programming language called PyTeal, and it's less battle tested, right? So Tiny Man was a DEX which got exploited, I believe late 2021, and I'm farming on Algorand knowing that there are these risks available, but I'm doing so because Algorand has a partnership with the FIFA Plus with the World Cup. I think this could be really interesting. I'm trying to put myself in a position to be lucky, because if the World Cup this year just happens to be the best in the history, then I'm going to assume that there are going to be moments in the World Cup that's going to be sold as NFTs that's going to be worth a bunch, right? So I don't I'm not buying Algorand. I'm just farming it for the past 8 months or so. And hopefully it ends up working. If not, I'll like farm and dump it, I guess. And also, with Algorand applications, yeah, I mean, they're less battle tested, right? They use Python as a programming language, but none of these projects have a token yet. So if you just have a little bit of assets across all these different applications, then you might be opening yourself up to a potential airdrop. So ALGOFi, which is the biggest application, is going to drop this token called Bank. If you're watching this video now and you're entering it for the first time right now, chances are you're not going to be eligible for an airdrop. Because I think they've been taking snapshots and whatnot. But the point is, and I was kind of joking with like these Algorand people, right? It's like, please, like I've been taking on the smart contract risk for quite some time now, right? Please reward me with like $200 worth of governance tokens. It's probably going to be not going to be worth that much, but why not, right? I mean, I still think Algorand's an interesting blockchain, and it could do well. I'm not that convinced, but the point of farming is that you don't have to buy these things. You can like farm it. Of course, you're taking on smart contract risk, but that's the point, right? I mean, the Algorand Foundation is saying, if you take on the smart contract risk, we'll give you Algorand tokens because you're taking on that risk and becoming an LP. So same can be said for the near farm. So and there are a bunch of other farms too, but I'm just giving some various examples. So great farms, but don't put all your eggs in one basket. Avoid tail risks. I had like at some point I had the majority of my stablecoins in the USN farm on Ref Finance, and it was like paying super well. I was like very, very happy. But then at some point I was like, you know what, like I don't want to be this DeFi guy and open myself up to, just getting wrecked because some tail risk happened, right? And I was like, you know what, like native tether just got issued on Near, but it's going to take a few months for them to, use that native tether to for the refinance farm. There's like technical complications there. So I'm like, you know what, like it's a good farm, but I'll de-risk that stablecoin farm if that makes sense. So, that being said, let's go back to the original question, like what's the utility of stablecoin farms and what can you actually do with it? And I just laid out these risks, not to scare you guys, but just inform and educate, I guess. Because my mindset is if I enter a basic stablecoin farm, sure, I can earn, I can outpace inflation, but it locks up my capital and, I open up myself to tail risks. However, if I use the USDC or Tether, whatever, as collateral on Aave, maybe it opens up myself to new opportunities. And though it might not be a perfectly delta neutral stablecoin farm, it might offer me more utility and it might offer me more yield. Which option makes sense for me? Okay, maybe for you it doesn't make sense for me, but for me this makes more sense for me. So let's talk about my strategy, because right now, of course, the environment sucks. Market sucks, but I'm still this guy looking at the fundamentals, and whenever prices dump, I'm a laughing stock, right? But it's okay. It's definitely a trader's market, right? And in the short term, you can't get to the long term without getting past the short term, and I'm definitely trying to be this longer term minded person. But there's a lot of volatility. It kind of sucks. But my bias is that I'll look for strong fundamentals. I'll deploy capital. And if I extend my time horizon, hopefully it works out. Right? There's no guarantees, but hopefully it works out and I don't have to be a doomer that way. So here's an example, Gains Network. I know people have been bothering me to talk about this for the past many months. So I'll just spend a little bit time on it here because the fundamentals are improving and I think it's an interesting project. I'm not a huge fan of their vault design. The tail risks of Gains is much higher than that of GMX, but it's a similar, it's a similar protocol. It uses synthetics, and not the protocol synthetics, but it's a synth trading platform using Chainlink oracles. And if you look at the TVL of Gains Network, focus on the purple mountain thing here, right? TVL on the DAI vault has been going up, meaning that there are more LPs entering this farm. Despite the bear market, right? They had a situation back in May where they listed Luna as a trading pair, and when it was basically going to zero, a bunch of traders shorted the Luna and they made a bunch of money, and it drained the LPs. So that's one of the tail risks because Gains lists all these tail assets. But despite those risks and TVL going down, or GNS going down, the DAI vault has been going up, which I think is really, really interesting. And if you go back to my videos back in June, July, etc., one of my reasons why I liked GMX so much was because, despite market sucking, GLP was going up, right? The amount of GLP was going up, which is good for the platform, right? It might be a leading indicator for these different platforms. So I can't really see into the future, but maybe it's a leading indicator for GNS gaining more adoption. And if you go to the trading volume, right, it's going up, right? If you go to the left side, the orange line is the moving average, 7-day moving average for trading volume. And yesterday it hit over $200 million in volume, and GMX had like $250 million in volume. So I was like, okay, people are using this platform. And if you look at the right side, we see that the number of daily users and new users picking up in a bear market. So, I mean, the platform has risks, right? And it's not a perfect design, in my opinion. So, I mean, that's one of the reasons why it has a lower market cap. But, I'm happy to look at this and be like, okay, like maybe it makes sense for me to, buy some of it. So my mentality, right, is saying, you know what, like, yeah, I can hold stablecoins, right? And, I can't lose money holding stablecoins, right? But I still want to look into opportunities, because I do think that when the markets are down this much, there are opportunities, right? Like, despite what you might see on social media, right, with all the doomers and whatnot. I might be wrong in the short term, in the medium term, and maybe even the long term. But I'm happy taking on the risks. So like my mentality is, I'll just like buy a little bit of GNS, right? Like less than my position in GMX, because I like GMX better. But maybe if the GMX synthetics platform that might launch in Q4, if that sucks, then maybe GNS gains more market share. And if GMX synths are just like god tier and they're amazing, then maybe GNS gets wrecked. But maybe GNS can just be like a hedge in case GMX doesn't do well. I think they can both coexist. And they're moving to Arbitrum soon, so. Like what I'm saying is that, I'll buy X% GNS. I have no idea what the markets are going to do in the short term. So because I want to protect downside and I want to be sort of delta neutral, I'll hedge my GNS by borrowing the same amount of Avalanche, right? So an X% AVAX and Aave, and then buy GLP with it. If I want to be perfectly delta neutral, like if I let's say 1% of GNS, then I have to borrow 2% worth of AVAX and then buy GLP with it, right? Because GLP is 50% stablecoins roughly. But I'm just like trying to simplify here. And obviously, like you can do whatever the hell you want, because GLP, right? It's, if you look at the middle part, right? It's like 55% stablecoins. It's like 10-13% Avalanche. So it's not like perfectly delta neutral, but what I can do is use stablecoins as collateral, borrow Avalanche, paying 8 to 12% APY. That's roughly where it's been, and then put it into here. I'm like hedging, and then with the Avalanche that I farm from GLP, I can pay off my loan that way. And also I get to farm more GMX, right? And I love GMX, and I don't really see, like, for me personally, I'm not gonna like buy GMX right now, because I can just farm it using these various strategies. So the benefits of doing it this way, like I'm not a huge fan of Avalanche right now. I don't necessarily see it outperforming the markets anytime soon. Of course, the markets go up, it's going to go up. But if the markets go down 10%, I would assume that Avalanche would be down more than 10%, right? And even if the markets go up, then I don't necessarily think that Avalanche is going to outperform that much. So, if I buy GLP on Avalanche, then like I earn a bunch of AVAX, but I don't know, like I don't really want AVAX right now, so maybe I can auto compound it back to GLP, which I think is a viable strategy. But maybe it makes more sense for me to use this hedging strategy where all the Avalanche that I earn, I can use that to pay back my debt, right? And if the markets go down, then my hedge is going to print money, and though my overall portfolio would be down bad, I would be down less bad because this hedge is going to be in profit, right? And maybe I can convert that into stable coins and sing kumbaya, and and not be as sad. Also I get to farm and stake GMX. I have no intentions of selling GMX. I'll just like see it through, right? Hopefully not get wrecked. And the third point, which I want to is like the more important point, is like, sure, I can enter stablecoin farms right now, right, and earn like 10% whatever, but maybe doing it this way, right, using stablecoins as a collateral on Aave, earn like 2-3% lending rate, and then using this borrow AVAX strategy to buy GLP, it might offer me better yield, even though that's not proven, but it definitely offers me more utility because it allows me to go bargain shopping certain altcoins, or just Ether, BTC, like whatever, right? It allows me to buy certain things and also hedge that downside by shorting AVAX and also farm more GMX, right? I'd rather do this with my stablecoins than just put it into some random stablecoin farm that you see on like some random chain or whatever, right? Yeah, so it's this idea of a pair trade that you can do with stablecoins because with the power of money markets, you don't have to use stablecoins as collateral, right? I'm just like using this example just to simplify things. You can just like buy BTC and then use that as collateral and borrow AVAX. You can do all sorts of stuff, but if I'm pissing myself about macro, right? If I'm pissing myself at the age of 26, then I'm really in. I'm really in a bad situation, right? I have nothing against AVAX, right? But I don't really see it significantly outperforming the market, so I don't mind shorting AVAX. And if Avalanche starts pumping, then chances are, like, if we're in that type of environment, then chances are like my altcoins will be outperforming AVAX, right? So I don't really care, right? In fact, I want to lose money on this Avalanche hedge because that means that the rest of my portfolio is outperforming. But if the markets go sideways, then I'm still like outperforming the market, probably, maybe not, depending on the, my coins. And if the markets go down, then at least I predict downside to some extent. Of course, GLP has risks. Everything has risks. I'm not saying that you should use GLP. I'm just showing GLP as an example because it's good for me. You can use Try Crypto. You can use you can go to like other money like. I don't know, like you can borrow Phantom and like enter the Phantom USDC pool or something, right? Like you can do whatever the hell you want. It doesn't really matter. But from my perspective, if I were to put all my stablecoins into one application, even though I just said that you shouldn't put all your eggs in one basket, I feel a lot more comfier putting everything into Aave than some random new smart contract that's less battle tested. Of course, I think people tend to estimate the risks of certain things and underestimate. So for example, I know GLP had like the price manipulation thing happen on AVAX, right? And then when that happened, everyone was like, oh my god, like GLP is dead, I must sell all my GLP, it's going to zero, right? But when things aren't going that bad, then everyone's like, oh yeah, like GLP, best thing ever, like I'm put my net worth into GLP. People overestimate the risks of certain smart contracts when something bad kind of happens, and underestimate the risks when nothing bad happens. But if you think about it, I mean, the risks are the same, right? Like whether a bad event or a good event happens or not. I mean, at the end of the day, like we're in this digital economy where we have money on chain. We want to make money, but if you want to make money, we have to take on risk. And if you are taking on risk, then we open up ourselves to downside risk. But what I'm saying here is that you can still buy things and open yourself up to risk and still hedge your portfolio by using money markets and these stablecoins as collateral this way. So hopefully, I think this is the last slide. Yeah, that's the last slide. Hopefully this video was somewhat useful. There's no guarantees that it's going to work. And maybe 2 months from now, Avalanche is in top 3 and I got liquidated, and I'll be making a video on asking for sponsorships or something, right? But chances are I don't think that's gonna happen. And obviously, keep a healthy health factor, manage your positions, and if the facts change, right, like liquidate it, like whatever, right? But the point is, everyone is like, there's like a bunch of questions about stablecoin farms right now, but you don't have to directly earn yield on your stablecoins. You can indirectly earn yield on your stablecoins using these hedging strategies, and also, if you're doing this, then it might offer you more utility because your stablecoins is not only an instrument to mute volatility in your portfolio, but it's also an instrument that you can use to actually make money on the way down because you're hedged, right? So thank you guys for watching. End of the video. See you guys. Hopefully you guys are okay. I'm hashtag bag holder, but let's see where the markets take us. Still bullish on the space. Being a DeFi guy in this environment definitely sucks, but I still focus on the fundamentals, and I think a year from now, I think it'll make sense, right? Even though in the short term it might not make sense, but who knows? Bye bye.